Hi folks, in today's episode we're going to talk to Casey Brown from 3000 Capital, and he is located in Kentucky. And that's not necessarily the place where you would say, well, is that the prime location for real estate syndication? But in today's episode, Casey will explain to us how he ended up where he is and how he was able, together with his wife and his family, to create a really successful business, and to some extent, if you're interested in syndications, how you can potentially participate in that to add that to your traditional residential portfolio that we are discussing typically here on the show. So come on in and listen to what we have to share. Hello and welcome again to another episode to the Ideal Investor Show. Today we have the founder of 3000capital.com, Casey Brown. Casey, welcome to the show.
Hey, how are you today? Glad to be here.
Yeah, I'm good. I heard that you said you had it really hot and really humid. So we have it hot, but luckily a little drier. So I guess we all have to carry our little burden a little bit. And for a little while, as I said, we were pretty close to each other geographically. So I know that you are in Kentucky. Tell us a little bit. I read the story, but I think our audience would really like to hear those things from when you first got interested in real estate and how you ended up being 3000 Capital.
So my journey started, I guess, when I was young. I obviously grew up in Colorado, as you said, and I had an entrepreneurial spirit from the very beginning. I would play with my toys and then realize that, hey, I could buy more toys if I could sell these toys. Then I could go buy some new toys and then continue to have the new stuff, I guess, if you will. And so the entrepreneurial spirit was really, and it just kind of started on its own when I was little. There wasn't any one particular event, but as I grew up and I moved, of course, I guess back to Kentucky, where I was born here, moved to Colorado, then moved back, decided that I obviously was going to go to college, and I went to a local college, Murray State University. And my entrepreneurial spirit, as I worked several of those just college age jobs, I realized like real quick that this was not for me. The man writing a paycheck every week and cashing that and going home, leaving home at 8 and getting home at 5:30 was just that was not my cup of tea. I was driving down the road one day. I saw a Caldwell Banker sign, of all things, a real estate sales sign in somebody's yard. And I thought, I think I can do that. I think that would be a reasonable business to be involved in, right? So I went and I had taken some college courses in real estate, which fast tracked my license, my ability to get a license. I didn't have to take but just a few hours of some continuing education classes and one basic class to get my real estate license. So that started my trek into real estate. And I started basically like every other real estate agent starts, hungry, tired, working side gigs to fund the advertising bills and the other stuff that came along with building a business in general. So I was in the real estate sales business for, I guess I still am. Still have my license. We still perform some duties here locally in order to press on with the capital raising business, which is really where my passion lies at this point. Now, I worked for, I'm going to say, the first 13 years of my real estate career, right? Selling massive amounts of real estate. We were really moving a bunch of units a year, still are for that matter. But with that being said, I had made like almost $400,000 in commission one year. And I had always heard that there was more millionaires and billionaires made in the real estate business than any other industry. Now, whether that holds true or not, or is complete, I don't know, but that's kind of the adage that I had always gone with or heard, and I thought, the year that I made all that money, I looked back. Of course, I had my living expenses come out of it, and we had taken some trips, and of course, all the advertising expenses that went along with it. And basically, I was just a job. It was basically just a job. I mean, I wasn't getting rich. I mean, I was making good money. Don't get me wrong, but I wasn't like headed down the become a millionaire or billionaire path. So I stepped back and I said, it's time to reevaluate. And there's some pretty big marketers online that I follow and some other things. They were always talking about these real estate deals. Real estate deals. Like, what does it take to buy a 250 unit complex? There's people out there that own these things. And what are they doing different that I'm not? And at that point, it was like all of a sudden, my business, well, I've got a degree in ag economics, ag business, agricultural economics, ag business. And all of a sudden, that business light went ding on in my head. And I was like, okay. So I had to start studying the legalities of everything and how it all fit together and what the SEC required and what types of documents. So I just engaged in this entire, like, immersed myself in this capital raising game. And I'm just like, wow, this is how it's done. This is where not only investors become millionaires and billionaires by investing in these things, but this is how you scale a real estate business. And it just, man, it's just been a wild ride ever since. At that point, I kind of had to decide what position in the whole real estate syndication or capital raising game that I wanted to pursue. And it just, man, all these different, like every day I would wake up with a new vision of where this was going. And of course, all the marketing things that go along with it, which we can talk about, whatever, but that's my journey. That's what got me basically where I'm at right now. So I started 3000 Capital. I think we filed our documents. I want to say it's been probably a year and a half or 2 years ago now. And so we're building, we're moving forward. We're shooting podcasts and we're doing podcasts like these.
And we're grateful that you're with us. So if I calculate that right, then this kind of heavy workload, you said almost like a job kind of time, would have been like something like what, 2007, 8 until like 2019 or so?
Correct. Yeah. And again, we're still actively in our local market in case people that are locally listening. I mean, my wife is for the most part taking over the day-to-day stuff for the local business as I continue to pursue this dream of not just doing syndications and doing deals, but being a successful and passing that success on to investors and gaining relationships in this business. And that's been the most rewarding part so far. It's like, man, how many podcasts are you on? And then how many podcasts am I on? And then multiplied by how many podcasts I shoot every week. And it's like, this is the most giving industry. We're all like, it's the true sense of, what do they say? A rising tide lifts all ships or whatever?
Yeah, lifts all boat. Yeah, that's the saying. I can totally agree with that. I mean, I'm super grateful for all the people that I've gotten to know and have built relationships with, both through the podcast, but also with our clients. And we work with lenders, we work with turnkey providers, we work with insurance organizations, title company or title insurance and title support organizations and stuff like that.
Sure.
In a sense, I think what you're doing, if I had to describe it, is a different variant of what we are doing. I mean, the audience is familiar with the fact that we are basically helping individuals build their own portfolio to own the assets, anything between single family and fourplex and anything in between. And with all kinds of different variations, like long-term rentals, short-term rentals, second homes, build to rent, international investments and so forth, but they all fall. And I have to say, I've been doing this now also for about the same amount of time as when you started. And I found I was very simplistic in hindsight. I guess we all would have to somehow admit that. Because I thought, well, the thing is, I'm in California, I can't afford for myself investing here and find any well-performing property. So I need to go out there where the well-performing properties are.
That's one of the things that I realized, and a little bit about where I'm at right now. So I'm about an hour northwest of Nashville, Tennessee, and a little community, Hopkinsville, Kentucky. And we've got some military, we've got industrial, we've got agricultural, we've got a decent mix of stuff here, but very, very, very few commercial opportunities in the true sense of moving the needle. You know what I'm saying?
Yeah, absolutely. You need to have the support structure and not only infrastructure in the sense of roads and stuff like that, but also from like the economic infrastructure, right? It needs to have, enough income, enough people making the right kind of money to actually afford certain properties. And we see the same thing. So to get a little bit in the conversation of where we are, I mean, for the audience, if you're not listening and following the economic news, we are literally recording this podcast at one of those days, which have become kind of like events now, when the chairman of the Federal Reserve announces what kind of next steps they're going to take, and everybody thinks they're going to continue to increase interest rates, maybe even increase more aggressively. So, Casey, I'm kind of interested. I hear for the first time in a long time where people actually start saying, well, have we reached the peak? Is money getting too expensive to get involved? Should we wait to see where this is going? And maybe next year, when we know more, come back to it. How do you answer those kind of questions right now?
So, first of all, for your listeners out there, I really it's my point to get people involved in cash flowing assets, no matter what they are, whether it's single family, whether it's ATM machines, whether it's billboard ownership, whether it's whatever it is, cash flowing assets. That is where the truest form of financial freedom exists.
Right.
And without cash flowing assets, because here's the thing. Now, I'm going to answer the second part of that question as far as the questions that are coming in right now as our current economic climate is somewhat seems like the clouds of shift are here. But when I talk about cash flowing assets and I talk about financial freedom, and you think about the wealthiest people on the planet, right? And if you look at their diversification amongst their investments, all of them have one thing in common, and that's cash flow. Because without cash flow, your capital gets tied up. You can't do anything with it. Without the cash flow, things just tend to not work, right? And so whether it's ATM funds, whether it's billboard funds, whether it's 250 unit multifamily apartment complex, whatever it is, get into cash flowing assets, because without cash flow, you're dead in the water.
Let me just comment here real quick. I'm totally with you. And I really want to hammer the point home. Cash flow, the way you just described it, Casey, for the audience, the important distinction is that it is happening whether you work, whether you're at the beach, whether you're on vacation and stuff. So it's like a passive stream of money coming to you while you can do other things without even defining what those other things are. That's really, I think, the biggest distinction between when you said, hey, I found out working a job from 8 to 5:30 is really not my thing. So the goal, I'm with you absolutely 100%, is get these assets that cash flow so you don't have to exchange time for money.
And it's all about replacement, right? So and I always tell this story. This is like the crux of who I am, right? So I had invested or had bought a house here locally, right? It was a $76,000 house. I bought it. We put about 20 or 25,000 into it, had 100,000 into it. Right. So then the market took its dump in 2008, 9, 10. So I ended up having to rent the house out. Right. So basically the house is sitting there as an investment. I only had $100,000 in it, and it was cash flowing itself. I was bringing in enough to pay the taxes, the insurance, and the payment. No harm, no foul. It just sat there. All right. So then I turned around, and after the things finally started coming up, my tenant had notified me she was moving out. I thought, well, I'm going to put that house on the market and see what happens. I sold the house for nearly $200,000, which left me about $100,000 in cash to do something with. So I got on the horse. I went out. It was right. There were still some foreclosures hitting the market. And then, this is a one-off story. This is not like a typical everyday what I go out and do, but you can, if you can scale it to this level. So I went out. I found a house that was probably worth $60,000 or $70,000. The lady was in terrible financial condition. The bank was getting ready. They were knocking on the door of coming to take this house. Right. And I mean, she was within days. I told her, I said, well, I'll do a 1031 exchange. You can stay here for 60 days for free. I'll buy the house from you for whatever you owe on it. Plus I'll give you, I think it was 5,000 cash over what she owed. Right. It was a good deal for everybody because it gave her some relief of a place to stay. It gave her 5,000 in cash to figure out what she was going to do with. I got the house. Right. So I ended up with like 30 grand in this house, and I was able to take the 30 grand, buy it, put the 70,000 into it. And then I rented the house for nearly $1,000 a month. Right. And at the time I was still young. I'm not young anymore. As you can tell, I'm old, bald, and everything I eat seems to go right to my gut. But with that being said, I had like an $1,100 something a month house payment. So I was like, boom, there it is. This house that I now own free and clear is bringing in $1,000 a month. My house payment was like $1,100. I just call it 1,000 just for mathematical purposes, but it was right there where it was basically going to eliminate my house payment. But not only is that house going to make my payments and build equity in my current home, but at the same time, after my current home is paid for, then the house is going to continue to churn whatever market rent it brings in.
It probably also increased in value itself.
Yes. And not only that, so you're getting a 12% return on the $100,000 investment right off the bat.
Right.
Before you do anything. You're getting 12% return, paying principal and interest on another property. I mean, it's win, 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 win. No matter how you look at it, there's like 8 wins there.
I'm sure you also then actually put your sunglasses on and shamefully went to the IRS to get your depreciation, right?
Yeah, then right there it is. You're like, hey, I gotta go. I need to depreciate this. Yeah, it's unfathomable that this is like, and this is like, it's such a secret, or is it? Or is it just something that, hey, you really like, you've got a square peg and a square hole, and it's just like people are just like, they're scared to put them together, and they fit.
It's really important. I think it's awesome that you helped me to educate the audience like I always do with passion. I can hear your passion about it. I believe, and I don't want to make it sound like a conspiracy theory or something like that, but I really believe there is, after having been in this for as long as I have, and you have been equally long in it, and I've talked to so many people, it is hard to fathom that it's just an oversight that our education system is literally refusing to tell people what is income, what is cash flow, how do you actually have positive cash flow, how can you get away from trading time for money. I mean, even if somebody says, I got an awesome job, I don't know, at Tesla or at GM or at SpaceX or whatever desirable job you might have, it's not to say you have to do this thing that you and I are talking about, but to basically keep it away from people so that, like you said, it feels almost like every time we get a little deeper, like we just touched on, it feels so for people to say, I can't even recall how many times people say, I don't understand why nobody has told me this before. Like, especially when people have gone far through life, like into their mid 40s, early 50s, and say, I've been around, I've not been, out of the news stream, and nobody, like you and I talk about.
Well, and there's a certain element here. There's a certain level of this that's emotional. Okay. I don't want to get down in the weeds, but there's a certain level of this that's emotional.
Right.
Because, like, for instance, my own father, right? He got up every day. He went to work. He came home. We worked on the farm. We raised cattle, went to bed, got up the next day, did the same thing. And if you would have looked at him and said, Mr. Brown, I'm going to give you $2,500 a month. You do not have to trade 1 ounce of your energy. You don't have to trade 1 ounce of your time. You don't have to trade 1 ounce of your anything. We're going to hand you $2,500 a month. It's like there's this mental block that's like, wait, money that I don't have to do anything for? What do you mean? That's such a new concept. And you're exactly right. There's a lack in financial literacy and financial education that, like, I remember in economics class when I was a senior trading stocks, but we were trading them amongst in our class to see
right
over this period of time who made the wisest investments. Right. And I kept thinking, that's cool, but if I take my $1,000 and I go invest it in a big soda brand or whatever, it basically sits there. And then that $1,000 is tied directly to whether a CEO decides to change the ingredients in this or do this or move this or acquire this or do that, instead of, like, and I just kept thinking there has to be a way. And then they're talking about dividends. The dividends was this huge discussion. And I was like, and I think my dividends over the 2 or 3 months that we did this, I think I ended up with like 19 cents. It was some absurd. And I'm like, really? Cash flow, dividends, cash flow, dividend? What are we doing here? And then once you start realizing how much money has to be crowded into one room in order to move the needle on that, then you start looking at, okay, if I took that same amount of money and put it into real estate and real estate investing, my initial return may not be off the charts. I mean, when you're talking about 9, 10, 11, 12, 15%, which don't get me wrong is good, great, actually, compared to some other things. But when you start looking at the intrinsic value of what's there and the fact that I'm always a big proponent of, hey, even if the house burned down, you still own the dirt.
You're absolutely right. And I mean, even if the return overall as an appreciation on the property is even just in the 5 to 8%, what I actually find really, really important in that context, just as making the point even more, is that in the initial phase, if you use leverage, if you go to your $100,000 house, you put 20% in, it increases to 105. Those $5,000 on your $20,000 investment is like basically a 25%.
And that's what the millionaires and billionaires that are in real estate realized well before. I mean, this is MBA kind of stuff. And I'm like, MBA, that's logical common sense.
Yeah,
You get an
exactly.
MBA to figure that part out.
Yeah, I agree.
Leveraging the bank's money.
Yeah, totally. I mean, that's leverage basically. And I mean, one thing that I always say, and because you said, well, if I were to go to my dad and say, hey, Mr. Brown, you get $2,500, that's one thing. The way I look at it, and I try to explain kind of like the service side of it, right? I'm sure Mr. Brown, you said, was raising cattle as a service for consumers to be able to have something to eat or have milk or whatever the cattle was used to. Well, to me, at least, I would be surprised if you wouldn't kind of come along on that thought, is to say, well, there is a fundamental need. And there are basically three fundamental needs, right? If you go to Maslow, he said, I think very rightfully so, and I'm quoting this regularly, is he said there are three things before you go to all the self-fulfillment, you want to sing, you want to become a star, whatever, you need three things. You need security, you need shelter, and you need food. Right. So your dad did the food part. If you would have said, okay, take some of the proceeds from the food part and provide shelter to people, and let's hope that our military keeps us safe, then you have that foundation, right? And that's with your properties and offerings, same like with what I bought or what I help our clients to actually get into. It's a different scale and it's maybe a little bit of a different mechanism, but fundamentally what we're all doing and try to do and get more people into. And that's why I'm saying it shouldn't be a secret, because we all need it and we all use it, is shelter.
Yeah.
And so to say, well, why is it a secret that only some imaginary entity that we don't want to really talk about is providing shelter unless we have finally enough to buy our own? Why isn't that something that everybody is aware of, right? And I oftentimes want to make that point, to say, yes, it's an investment. Yes, it gives you the cash flow. Yes, it gives you the performance, but it's not just out of thin air. You're providing a service to people who need a place to live.
That's right. And there's any number of, again, the ways to look at it is infinite. Now, before we go much further, I'm going to go back and be a little bit vulnerable here, because as I had stated in that context of where I was when I bought the house, was making my house payment, so on and so forth. Now, I was awfully young. Okay. I was awfully young and very, very, very naive, but I'm going to even drive the point of cash flow home further than I have already. Now, I then took these paid for properties. And then, of course, my human nature or my young nature, whatever it is, stepped in and thought, well, hey, let's leverage this, right? Now I'm able to use this house that's worth this and use it as my 20% down on all this other stuff, right? So I was buying rental houses, continuing to leverage, and continuing to leverage. And then all of a sudden, there's this little thing out there and it's called life. And it walked in and it kicked me square in the rear end in the form of a divorce, right? And so with that being said, it's not always turbulent. It's not always steady air. Sometimes it gets turbulent, right? And so I obviously am hit with a wall of, I had to make a choice one day, whether I fight for my kids or I fight for my stuff. And I think that we all are well aware, at least my family is well aware of which one I chose, and so are my kids. But at that time, I had these rental properties that we were moving forward with, right? And I didn't truly become broke until there couldn't be a settlement on those rental properties amongst myself and my ex-wife. And I actually sat down and sold every one of them. And we sold every one of them. And at that point, that cash flow being cut off was the noose. I mean, that was it. That was it for me. That basically 100% meant I was going to be broke, end of story, and that was it. But the importance of that cash flow had carried me far enough to help me keep my kids from being moved away. And so, as well as it carried the properties themselves. But the day they were gone, like I said, that was the noose. That was the end all. I'm broke. I'm at the bottom. Life has now kicked me in the rear end, and here we are. Now, that is the vulnerable situation that I know a lot of people get put into. And I say all of that to come back and just press home the importance of cash flow. If you don't have cash flow, you can go out and have $1 million. And if you go blow it, it's gone. You have the stuff, right? You don't sell the stuff for the $1 million back. You go out, you buy $1 million worth of property, you spend the income, the property's gone, you blow all that income, you still have the property. There you go.
Yeah, absolutely. I love that you were willing to tell the story and be vulnerable in that way. And congrats for keeping the kids.
It worked out good. I mean, it did. So
one of the things that I find equally important in the space that we're both working in is, and people would know that if you were a client of mine in our program, I would at some point after we gotten into the first few deals tell you, hey, Casey, we need to build the Brown empire. And what I mean by that, and I say this to every one of our clients, is that empire is the legal structure that basically protects you by really turning this legally into a business entity with land trust for each house, with a LLC around each house, with a series or what's called a Delaware trust structure, with an operating company and so forth. Because when it's being looked at legally and otherwise as a business entity, that doesn't mean that things that you described can't happen to it, but there is a framework around it that is basically settled. It's the same thing, and maybe that's a good transition to what you do now with your larger projects and the capital raising. There is a very clearly established legal framework and SEC framework and so forth around it, which I would say it's probably impossible for somebody to say, because I'm in this legal framework and I bought one unit in 3000 Capital's latest fund, that I'm now suddenly not going to be able to know who is going to take it, who is going to grab it, or stuff like that. So maybe we want to transition to that and tell people a little bit, how do those investments that you're offering actually look like? What are the minimums? And especially kind of going a little bit back to where we were to answer some of the questions that people are currently concerned about in rising interest rates. And
yeah, and that's where, I was just sitting here thinking, I'm like, yeah, we owe the listeners at least a little chat about where we are right now. So as this is being recorded, of course, there's the rate hikes that are stepping in, they're trying to do it to curb inflation, which we were all aware of was coming, when COVID hit. Honestly, I'm not quite sure exactly how bad things really did get during COVID, because they weren't bad here in small town USA. The real estate market was booming. Unemployment was still relatively reasonable. It wasn't an end all type scenario, like I guess where possibly it was in other places, or maybe it was a manufactured scenario. I don't know. Either way, the trillions that were dumped in, whether it was through PPP loans, whether it was through unemployment, whether it was through stimulus payments, whatever it was, the trillions of dollars that were dumped in were, have now crowded up and pooled in the banks. And, the cost of everything has risen, especially like a bottle of ketchup, a block of Velveeta is up 20 something percent, whatever it is. And so when we're looking at all of that, the cost of borrowing money had no choice but to go up. Now, I am also of the opinion that people always say, okay, well, why do they do it all at once? Why couldn't they just do it a little bit at a time? That I don't really have an answer for, other than just, I guess they think, hey, we'll do this, we'll take it in larger chunks, and that way it takes effect faster than if we did it slight. I don't know.
I think one thing is, like you just said, they want to have an effect quickly. Some might argue there might also be a little bit of a political thing behind there. But my answer to the question, why so drastic, why so harsh, so to speak?
Yeah,
I believe it's necessary, not because it has to be that way, but because you need to, I believe, I hope at least I'm right, that the people look at the bigger picture and say, okay, how long can we actually sustain a higher level status? If
Yeah.
we were to step by step do 25 basis points, 50 basis points for 2 years, what is misunderstood is this money that you mentioned, those 35% of new dollars out of all dollars that ever existed being printed in the last 2 years. That amount of money is not money that came from any productiveness, from any kind of manufacturing. It was literally just printed, which means it came basically and added to the national debt, which in turn means if you had 25 trillion, and I can't even fathom the number, but if you had 25 trillion, you add 5 more trillion, that is a huge amount of money. But when your interest rate is 0 point whatever, you might be able to manage it, especially when your economy comes back. When you now crank up the interest rate to, some people estimate it to go to 2%, 2.5%, 3%. I'm talking what the government has to pay. That's not what you and I, then you have to add 3 or 4% of what you and I have to pay. But if the government goes from 0.25 to 3.5 or something like that, that's 7x just on the interest. And when you have 30 trillion and you pay 7x, that's my argument why I don't think they could afford to go very long. I'm actually estimating no more than 3 years from now, we're basically back with the interest rates where we were, not because they're so gracious in one Casey and Axel to buy more real estate for like 2 or 3% interest. They just can't afford to pay. They would pay basically all the tax money that comes in exclusively just to serve the debt.
That's right, just to service the debt.
That is unsustainable. And that's, I guess, why they decided, let's do it fast, quick, high, and then get back to where we need to be. Yeah.
And another one of my endless ways of comparing or discussing this world. So I had a guy tell me one time, and several years ago, he said, imagine that item or that toy that you just went out and bought and wrote a check for. Okay. Imagine that you took, rather than paying them in money, you paid them in just little bits of your time. Like you just exchanged time for that good. That good comes to you, your time to earn that money goes away, right? Now, when we talk about the national debt, you talk about the trillions of dollars. And if you were to convert those trillions of dollars to hours of work by every American individual, what would that look like? The calculation changes constantly. But what I'm getting at is a lot of people look at the national debt and they're like, okay, we owe this much money. Well, we do. We owe that much money, but we actually, in all truthfulness, we all owe little bits of our time that are enough to cover what that debt is. And when you look at how much debt there is, and when you look at that and you kind of correlate that with the time that it's involved, that it's going to take for us to pay that off, you're right. The interest is not doable. It's not sustainable. They can't then fix roads and do the maintenance and do the stuff that has to be done by simply servicing the debt, which is, again, what do we call that? Over leveraged, right? And they're over leveraging themselves, and they're putting all of us in a bit of a quandary when it comes to having to pay back that debt.
Yeah, absolutely. I'm with you on that, Casey. And I like that analogy a lot, especially because what people need to realize when they listen to you and me here on this podcast is that the maximum you can give away in any given time frame is basically what is in a fiscal year. You can't give away next year's time, right? That's why governments have budgets. So it used to be, I don't remember, and I don't know exactly what it is now, but I know it used to be right around the time that we are now, sometime in June, people started to actually working for themselves and no longer for the government. Now, the higher that burden gets, you might need to work until September. And at some point, and I think we're not very far, and we will definitely be not very far from the point when interest rates get too high, where you're working from the 1st of January to Christmas and have not put any penny in your pocket. It's just not sustainable. You can't just work for like...
How much equity is this country burning through? You know, and again, we can get into every aspect of political discussion about it. Still, it all comes down to we as a population in general, we find the craziest things to complain about on Facebook. We find the craziest things to complain about on social media. We follow the most ignorant sources of news that there is anywhere on the planet. And yet we still, we can't figure out that everybody owes this. It's not just me. It's not you. It's not the next 10 people. It's everybody.
Yeah, absolutely.
And
no, I agree with that. But I mean, why I think it's valuable, because it kind of feeds into a growing fear that only a select few people, and at least I would say, and I hope you don't mind me saying, I think you and I are normal people that, anybody could hang out with and do barbecue with, and we have an upbringing that is completely normal. It doesn't, in my experience, take something extraordinary or special or so forth to get the concept, but there is a growing fear. So when people listen to us today and say, hey, 3,000 capital, Casey is a cool guy, I would like to consider what he has to offer, but I'm a little afraid of what I'm hearing. Can you describe how getting involved in your funds actually looks like?
All right. So, of course, when you start talking about real estate funds, they're a little bit different because you have a lot of different angles to take in. And I'm not sure, if the listeners out there familiar with the term capital stack, which basically is the order in which everybody gets paid, right? You start with the debt, sometimes the insurance and expenses, they're right around there as well. Then you've got mezzanine debt, then you've got investors, then you've got LPs, which is the investors, and you've got GPs, which is the syndicator or the sponsor or whatever the case is. And so basically, when you invest in a real estate syndication in general, you're investing in three different things. You're investing in an asset in a specific location, operated by an individual. An individual at some point is going to have oversight of everything that goes on, right? So those are the three main things that you're investing in. When you take your $50,000 and you put it in, those are the three things you're investing in an individual deal. Now, when you invest in a fund, our fund is set up where we are called a fund of funds, right? So when you invest in that syndication, that individual syndication with that person, with that sponsor, with that operator, whatever you want to call them, and they say, we're going to pay you an 8% preferred return, right? Preferred return, whatever you want to call it. And your $50,000 is going to buy you one Class B share in that asset, and it's got an 8% preferred return, okay? You come to us with that same $50,000, we have a negotiated agreement with three specific operators, right? And what we look at is a laundry list of things when we talk about these operators and how we procured them down to three. And a lot of it was asset class. So you invest with us and we take your money along with 9 other investors, $50,000, and we take $500,000 to the deal and say, hey, Mr. Operator, we want to buy one Class A share with this $500,000. And now we're going to get a 10% preferred return, right? Now, that preferred return, again, then it comes back to us, right, as a 10% preferred return. But then this is just an example. We pass back 9.5% or whatever the case is back to our investors, which is 1.5% greater than they would have gotten had they gone in individually.
Right.
And then we make a little bit along the way. Now, we make a little bit along the way because we have vetted these operators. We're aware of the diversification responsibilities that we have to our investors in keeping their money diversified across geography and determining the asset classes that we invest in, that we specialize in, that we know what to look for, and then the operators. So we've got operator, geography, and asset class nailed down. Now, where does that preferred return come from? And it comes from that capital stack that I referenced in the very beginning. So you make the mortgage payments on the property, then you take care of the expenses that go along with ownership of the property, whether that be maintenance, insurance, things of that nature.
Right.
Then the limited partners or the investors get their preferred return, right? So basically a preferred return basically means that you're getting paid before anybody in the GP side is getting paid anything. You're going to get your 9.5%, 10%, 8%, whatever it is. Now, with that being said, we still have to provide the disclosure that none of that is guaranteed. Okay. Right. The only thing that's guaranteed is that they're going to get paid before the general partner gets paid. Now, the general partner gets paid basically on the hopes that the asset is going to perform and it's going to make the capital money that we all hope it makes with the raising of rents and so on and so forth. When somebody approaches us about investing in our fund, we ask a lot of questions, and we don't just open door for everybody that has $50,000 to come and invest with us, right? Because we still have a responsibility to our operators to ensure that we're not dragging somebody in here that's got tainted money or something like that. So there's still that idea. But the idea is you invest with us, we invest with our operators that we know at levels that we know how they operate. We know what their past returns look like. Obviously, past returns don't indicate future results, but we know in general what the expectation can be.
Yeah, that's a great explanation. And one thing for me, and tell me if I'm getting this wrong, if we look at a regular deal that my audience is probably a little more familiar me talking about, there's always the component of the external money. You could call it bank money or lender money, and the internal money, right? And if I understand you right, Casey, in a way, the money that you're collecting is more akin to internal money than having to go to like an external entity like a bank or a hedge fund or stuff like that and say, hey, we have this project and we want to convince you that this is a worthwhile project to put your money in.
Correct.
Right?
And we're basically crowdfunding a Class A share. If you really got down to just exactly what it is, we are where the rubber meets the road, puts us into the investor relations business. Okay. And it takes us into what we specialize in. I specialize in talking, discussing, meeting with, connecting with people. Okay. I don't specialize in going out and having to get in a property manager's rear end because all this stuff needs to be done. I don't want to do that. No, I want to say, Mr. Investor, I got my eyes on this guy over here. We're good. We're good. Everything's cool. I talked to him the other day. This is what's going on. And which puts us in the investor relations business. And for those of you that are listening, I'm moving my hands. I'm very animated. For those that are watching, I'm sorry. You have to follow my ADHD hands. So we are in the investor relations business. And again, with enough education to know what, who, when, where, how, all of the elements that we need to look at when it comes to taking our investors' money and putting it into a deal.
Yeah, and I think that puts a really nice wrap around it, because when we started, you described your journey. And I think to be able to have the eyes, ears, and other senses out there on behalf of your investors is much more credible and understandable when you have worked and lived through that experience, have seen the things that can go wrong, and obviously are sensitized to keep an eye out for that and raise your voice when necessary.
And we're in an advocation spot. We're going to obviously advocate for our investors at every turn. Hey, I don't like the way that over there is being done. And there's an element of this that I didn't get into, and I'm not going to spend too much time on, but there's an element of this, like part of our operator vetting process is actually putting eyes on properties that they physically own today, because the way that they treat their tenants is probably going to be the way they treat the people that they're maybe considering an investor or whatever. And if they're not treating their tenants good, then to be quite honest, I'm sorry, but myself and my investors, we just don't want any part of it.
You want certain character traits that show up, and if you
correct,
I mean, obviously there's enough money around, so you don't have to take everybody.
Absolutely, yes, sir.
Great. So as we come to the end, I think we really kind of gave a good picture of what it is and how it works, and why you would be a great relationship to have if somebody's interested to get into this preferred investment opportunity. So I always ask at least two questions at the very end. I want to ask you, Casey, if you could meet anybody, even past or present, who would it be and why?
Wow, that's a good question. That kind of took me off guard there. I'll be honest, if I could meet one person, past or present, and I know it's going to be, there's an array of people. I tend to think about people that moved, like that made people move, and probably one of the best storytellers of our time. You know, I'm not of the same political affiliation, but Bill Clinton, you know, he had a human element. He had his why so defined that his human element could overcome anything.
Yeah, I agree with that. I have to say, you know, in the environment that I got to know about and that we have seen in the last, 20 years or so forth, you have to be a pretty strong leader to actually, and I know we're always looking for money, right? But to have a surplus in the day and age that they were going through, and actually really moving that many people. I'm with you. That would be an interest. I would want to come along to that conversation if you.
Yeah, I just think that again, not and I always try to judge figures like that based on what would it be like to sit down and just have a beer with them and not discuss guns and religion and politics and
Right. Yeah.
just say, hey, tell me how, but because like I said, you see such a human element there, and his ability to move somebody from point A to point B was just really very intriguing, and almost to the point of mass manipulation to a certain degree, I guess.
Yeah,
But
definitely. Yeah. No, that's
but
cool.
that makes it sound like a malicious, which I don't necessarily believe in that either.
No, I mean, for me, the thing is that's why I use the term leader, right?
Yep.
Leader has a vision that people can kind of line up behind and believe that they are being taken care of better than they are right now if they follow that leader. And I think that's a quality that he has, you know.
Yep.
So,
Yep.
all right.
Okay.
What the other question, and you may have seen that in the notes before, is if you had a time machine, you could go anywhere. We have the special machine that go backwards, forwards, upwards, downwards. Where would you go and why?
Oh man, and I'll tell you, it comes back. Oh man, wow, that's so interesting because I actually had this discussion with my kid the other night. Well, my oldest child the other night. He said, if you could go back to 1 year in your life, what would you go back to? And stay there and nothing, and I told him this was my answer. I said, son, I said, if I go back, I don't have the knowledge that I have today. If I And that's probably the biggest holdback for me saying, yeah, I would want to go back till I was 15 or 16 or 20 and just stay there, because I was such an idiot. I was so naive to how this world actually works and how things work. But this would be more of a personal trip probably than a business trip, because those people that know me really well know that I'm a huge, I like rap music probably better than anything. There's nothing I like better than sitting here thumbing away, working on something just to the beat, whether it's freestyle rap, whatever it is. But back to a person along the lines of what I mentioned with Bill Clinton, that just moved people, that just made people's emotions so raw and really defined the situations that were going on in the civil world, was Tupac Shakur, one of probably the greatest poets, one of the greatest, a lot of things, because he didn't care. He spoke his mind. He told you the way he felt, and that was the end of it. He did it through music. And I've oftentimes said, those of the folks that are closest to me know that if I had a time machine, your exact question, and it's always kind of been a joke, I would go back to his last concert. And again, that's one of those moments in time that you feel like somebody, you would be media or going to see somebody that's moving people from A to B and doing it through story.
Right. Yeah, that sounds very cool, and I can totally imagine that. And it's not even necessary that you don't know what you know now, as long as you're an observer. And I always say, as long as you don't disturb the time-space continuum, you're good to go.
The time-space continuum. Yeah, I was like, yeah, just don't do anything that changes what's going to happen in the future.
You
You're
can
good.
be at the concert because it's obviously a million times better than seeing anything like that on YouTube. So, that you can do, you just don't fiddle with it.
Yeah.
So,
Yeah. The only thing that would be better than that would be to go back to when my last daughter was born, and I wouldn't have my stepkids in that case. And I told my son that, I said, if I went back and was there just with you three, we wouldn't have our stepson. We wouldn't have my stepsons, Mac and Jude. And so I just, it's one of those deals, but you have any number of things to think there. Those are great questions.
I guess
that.
that's, if you do the first trip well, then you get a bonus trip or something.
That's right. That's right. That's right.
All right, Casey, it was wonderful to have a really nice, free-flowing conversation. I think people have a little bit better idea how they could invest in a fund like what 3000 Capital is offering.
Absolutely.
So if somebody wants to get in touch with you, tell us real quick, how can we do that?
My website, 3000capital.com, is a good place to start. My preferred method of reaching out and finding more about who we are and what we are is through my podcast. You can find that at www.cashflow.pro. There's no .coms, there's no nothing. It's cashflow.pro. You can go there. You can hear my interviews much like this with folks, and we dig into basically every aspect of real estate investing and the time components that are involved, the financial components that are involved, and beyond. So, and thank you so much for having me. I really, really appreciate it. I always look forward to opportunities like this.
Yeah, wonderful. And we appreciate you coming and spending quite a bit of time with us. Cashflow.pro. That's a cool thing. I will check it out myself. And
Absolutely.
we put all of that in the show notes so people can find it. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.